Hello, Mr. and Mrs. Swinson. It was a pleasure meeting with you last week and getting to know a little bit more about your family. I was able to compile your information and summarize it into a few reports with a few of our recommendations that I hope will help get us back on the right track and help us meet our goals. I wanted to give you a quick overview of our meeting agenda, and then we'll dive right into the materials. First, we're going to review the current economic environment, and then we will review the information you provided to me last week and the goals you have for the future. Second, we'll go over the areas where I feel you have strengths and weaknesses, and then we will review my recommendations to help you reach these goals. Finally, we will review projected financial information if we were to implement these recommendations. This will give us time to ask any questions you may have regarding our next steps. So let's dive right in and look at our current economic environment so we can see what kind of opportunities and challenges we will be facing. In the last few years, we have been facing a great deal of headwind in the global economy. However, we have been seeing more positive signs here recently. For example, we have had a very strong start to the year with over double-digit returns in the markets. Corporate profitability is at all-time highs. GDP has been growing, though it has been slow, and consumer confidence has improved. However, risk and uncertainty still remain. We have had a pullback in the market for the second quarter, which is very similar to our path in 2011. The unemployment rate has been dropping, but unemployment is still extremely high, and the number of people who have been given up looking for work has increased by large amounts, making this number a little misleading. Cost of essentials such as food and gas have continued to rise. Global debt, especially in Europe, has brought great concern of global turmoil, and our economic growth has been moving at a very slow pace. So even though we have had some positive news in the first part of the year, we still have a few hurdles in our way before we begin to truly recover. I've listed out a few of the assumptions I've made for our presentation today. I won't go through them all in detail, but list out inflation, growth and return rates, expected future college education expenses, current loan rates, and our current tax bracket. Note that for our current tax bracket that we'll be assuming the tax rate will remain the same for next year. However, some federal tax provisions are set to expire at the end of 2012. If this expires, taxes will be increasing across the board for individual income, capital gains, and dividends rates, among other increases. The final point I would like to make is that we'll be making some recommendations for your entertainment, vacation, and miscellaneous budget. However, we'd like to see more detail for these accounts before we implement these recommendations. Now we are going to look over the information you had provided to me last time so we can see how everything comes together for your family. First, let's go over your objectives for this meeting and the future. So Karl, I know you are interested in purchasing a new truck to replace your current truck that is 14 years old. We'd also like to have a review of your life, health, and property insurance policies. We'd like to review your investments and see where we can make some improvements. We want to make sure your plans for the future can be fulfilled through appropriate retirement and college education funding. And finally, we would like to make sure your estate planning and documentation is updated. These are the major topics we will address during our meeting today. To get started in the right direction, let's review where you stand today. Here's a very high-level summary of your position in the life cycle. As we can see here, Karl is 32 and Mary is 29. You two are married without any children or dependents, though there are a few immediate family members in the picture. Your net worth is currently $70,000, of which over 100% of that is from Karl's IBI business interest. We can also see that your income levels are very good for your age. If we turn to the next page, we'll add a little more color to this slide. So after looking at your stage in the life cycle, we can see that you're in the asset accumulation stage. In this stage, we'll be focusing on accumulating assets in order to create an emergency fund and start saving for retirement, education, and other large purchases. You both are in the prime of your working career, so life, health, disability, property, and liability insurance will grab a large portion of our attention here today. We'll also need to focus on managing your debt, opportunities to minimize taxes, and how we can begin planning for your estate and business succession goals. I've been able to summarize your financial information into a balance sheet in order to understand our current asset and liability position. You can see we have assets totaling over $260,000, consisting largely of your IBI business interest and your home. It may not be surprising to see your home and auto loans make up the majority of your liabilities. However, I do want to note the fairly high balance on your credit card. Understanding that your current interest rate is 12%, this will be one of the most important areas we will look to improve upon. After our liabilities, we can see that your current net worth is just over $70,000. You can see a few of my notes at the bottom, and then we'll help you get a little more information on each one of these line items. Here's some additional color to see how you stand relative to the benchmarks, which are based on industry standards. You can see that you have a larger portion of personal use assets and a smaller portion of investment assets. This is to be expected when saving for retirement has just begun. Once we increase these savings and have both of you investing appropriate amounts into a retirement fund, these ratios should begin to better fall in line with the benchmark. And you can see that your long-term liabilities are larger and net worth is smaller than the benchmark. Paying off your credit card and increasing your savings will help to improve both of these ratios. This is a summary of your income and expenses for the past year. Total inflows are just over $100,000 with both of your salaries combined and a little bit of interest. Total outflows are a little higher, making your net discretionary cash flow negative. We will look to target your debt payments and your entertainment and miscellaneous expenses to help improve these cash flows. Again, there are some footnotes at the bottom that help explain some of our line items in more detail. And here's a pie chart comparing your allocation to the benchmark. There's very little you can do to improve on your tax piece, but we will target reductions in living expenses and debt payments in order to filter these funds to your savings and insurance payments. In a few slides, we'll go through our recommendations on how to put these plans in motion. We will have a few slides to review your current insurance policies. Let's start first with your life insurance. I see you both have $10,000 term policies paid by First Credit Union, and Mary has a policy through work for 2 times her salary with an annual premium of $24. A few recommendations I would make regarding life insurance would be to purchase a $500,000 term policy on Karl's life. This will be an annual renewal term policy, but with your good health, I believe the savings and annual premiums far outweigh the potential risk. I would also recommend that Mary increase her term policy to 5 times her salary because the annual cost would only go up by an additional $76. These changes will go a long way to improve your life insurance coverage. I do also want to note that I see you are both beneficiaries of your own policies. I would recommend that you both update your policy to list the other spouse as the beneficiary. In the event one of you should pass away prematurely, the insurance proceeds currently would need to go to your own estate and then to probate. Naming your spouse as beneficiary will avoid any potential headaches with the probate process. I also would like you to know that I will be going over a few recommendations along the way, but I will also provide a summary of our recommendations so we can see how every recommendation fits into the big picture. Mary receives a very strong benefit package from work, and we see more of the same in regards to health and disability options. The health plan paid by Global Accountants covers the family in 80% of the out-of-pocket costs until a max is reached. The deductibles are reasonable at $500 each and $1,000 for the family. Mary also has a disability plan paid by Global Accountants with a $10,000 deductible and 60% of salary paid until the age of 65. These coverages are very adequate for Mary, but I would recommend that Karl purchase an own occupation disability policy. Especially during the asset accumulation stage of your life cycle, it is vital to ensure your earning potential in case of an accident or sickness. This policy will only add $900 of cost a year, but will provide the necessary coverage you will need. The one final note I will add for health insurance is that I would recommend contributing $1,000 to your employer's health savings account plan, Mary. Considering you have $800 of out-of-pocket medical expenses throughout the year, this account will allow you to use tax-free contributions to make these payments and save a little extra cash. I feel very comfortable with your homeowner's insurance coverage. Your coverage is adequate and your premiums are reasonable. However, the few minor changes I would recommend are to increase your deductible to $1,000 and change your coverage to an HO3 plan. The cumulative effect will only be an increase of $100 to your annual expenses, but the HO3 will add additional coverage. An HO2 coverage specifically lists the events that are included in your coverage, while an HO3 policy will specifically list the events that are excluded. If it isn't specifically excluded, it is covered. As a result of these changes, you will receive additional coverage for marginal cost. I was able to take a look at your auto policy and noted that you have very adequate coverage here as well. You each have $100,000 of liability coverage per accident, $300,000 per person in medical coverage, and $50,000 per accident for uninsured motorists. My one recommendation would be to increase your deductibles to $500 on collision and comprehensive claims. This will help to lower your premiums by $350 annually. One final note on insurance. I would recommend an umbrella or PLUP policy to give you a broad level of additional coverage over all of your policies. This will add only an additional $200 a year, but will give you an additional layer of coverage should anything major happen. A review of your investment information and goals show that you are looking to earn an 8% return on your overall portfolio, including your 401k, retirement, and education savings accounts. Currently, your savings are in Mary's 401k, which has earned 36% over the last year. This performance was exceptional and cannot be anticipated to occur on an annual basis. Returns should be more in line with the long-term averages of 5 to 6% for this growth fund. Knowing that you will only be earning 1% in your money market account and you expect to return 8% on the investment in IBI, your return may not reach your 8% target. As we increase our retirement investments, it may be of interest to invest in equities returning around 8% over the long term. These investments carry higher risk and standard deviations, but should be smoothed out with the long-term investment process in the retirement funds. Speaking of risk tolerance, here is the investment policy we have put in place that will help direct our recommendations and long-term commitments over the investment cycle. We have created this policy using your risk tolerance assessment form. Our goals are to fund a retirement account to support your desired lifestyle, provide an education fund for your future children, return 8% on your investments using a moderately conservative plan of action. We have a relatively long time horizon to meet these goals as Mary plans to retire at 62 and Karl at 65, and college funding will not be needed for at least another 18 years. Some constraints of the plan to consider are your current high debt to equity ratio and liquidity issues, the business risk, which we will touch on later for IBI, and possible reductions in income due to life events, such as having children or an accident or sickness. Here we're taking a look at our retirement expectations and ways to minimize taxes. As we said before, you expect to retire in your early to mid-60s and expect your retirement living expenses to be about $95,000 in today's dollars. We will be funding this retirement account through Mary's 401k contribution and match to work, the pension she is scheduled to receive, and the Social Security payments expected for both Karl and Mary. Our recommendations should include an additional retirement account in place for Karl's contributions. We also want to make sure your estate documentation is up to date. We will help you to set up a meeting with an attorney to prepare this recommended documentation, such as your wills, powers of attorney, and other provisions. We have talked about your financial position in relation to the benchmark a few times, but here we get to see the numbers in more detail. The emergency fund has less than 2 months of non-discretionary expenses available. We recommend adding to this fund as soon as possible to last 3 to 6 months, as this will give you adequate time to recover in the event that income is unexpectedly lost. A few of our recommendations will help to increase this fund. We recommend that you have enough cash on hand to cover your current liabilities, so our increases to the emergency fund will help increase this cash to current liability ratio. Your mortgage payments are within the benchmark, but we can improve them even further by increasing deductibles and refinancing that first mortgage. Debt to total assets are fairly high, and this will be another focus of our recommendations in the next few slides. These risk management ratios show that your current life insurance coverage needs to be increased, while your other coverage amounts are adequate. However, we have made a few recommendations for your insurance policies that will help to improve these ratios appropriately. This final slide of ratios highlights the need to increase the savings rate for the retirement fund. Considering our other immediate cash needs, funding the education account will be best after your first child is born. And finally, as we discussed earlier, here's a list of estate documents that we should strongly consider completing in the near future to make sure assets are going to the desired people in the event either of you pass away prematurely. I wanted to take a look at your business as well today, especially considering how important the business is in relation to your net worth. I understand that this business has been successful and appreciating, but I do want to highlight the possible risk involved. The business has financial risk because it is highly leveraged and may need to take on additional debt as it expands further. In regards to business risk, cost of production and demand can change quickly. You have executive risk in the sense that you do not have a business succession plan. What happens if an owner wants out or passes away? It is best to have a plan in place before issues arise. Valuation risk is also important to consider because what happens if the business does not appreciate by 8% per year? And will there be a buyer ready when you are ready to sell the business? So as we were talking about the business, I also wanted to note that the business has a status as a C Corp. While we are creating a business succession plan, it might be a great time to consider electing S Corp status. C Corp distributions go through a double layer of taxes. Electing S Corp status will remove this second layer of taxes. Once we have more details about the business succession plan, let's review how the S Corp status can play a role in that plan. Alright, so now that we've gone through the data, where do we stand? Let's start by summarizing your strengths and weaknesses. Your strengths are strong salaries and good health, long time horizons for retirement and education funding, manageable mortgage payments, which make up the majority of your liabilities, great benefits from Mary's employer, including a 401k match up to 3%, a pension plan of 70% of your final year salary, paid health and disability insurance, available health savings and plans, and you have adequate homeowners and auto coverage, although we can make a few improvements to those areas. Now, some of the areas that we will need to make improvements include a current negative discretionary cash flow, inadequate life, disability, and PLUP coverages, mainly for Karl, low deductibles on your homeowner and auto policies, which can be increased to significantly reduce your premiums, a high credit card debt and debt to total assets, an emergency fund lacking real substance, excessive expenses relating to entertainment, vacation, and miscellaneous expenses, a high-risk asset, an IBI, with a lack of a succession plan, a lack of estate planning documentation, and insufficient returns on investments. The questions I'm sure you are asking is, how do we make these weaknesses strengths? Well, let's jump into our recommendations. Here's a summary of our recommendations. I have gone over a few of these already, so I'll try not to repeat myself too much. Regarding investments and retirement, I would recommend Karl participate in a retirement savings plan, whether that be one offered at IBI or a separate IRA account. I would start by contributing about 5% of your salary per year until we are able to improve our emergency fund and pay off some debt. Then I would recommend moving the contribution to 10%. Mary should increase her 401k contributions to 5% of her gross pay and continue to contribute into a diverse portfolio mix according to her investment policy. I will note that I will recommend you increase this contribution to 10% annually and consider taking on a potentially more volatile fund in order to reach a long-term return of 8%, as we had discussed earlier. Finally, I recommend that we monitor your performance and strategic allocation quarterly to make sure we are rebalancing the portfolio properly. Continuing on the theme of investments in the future, I have a few recommendations regarding your education funding. I recommend that you hold off on funding the education fund at the moment until you have your first child. You will have 18 years to make annual 5% contributions, which should be adequate to plan for college education expenses. At that point, I would also recommend using a 529 plan to hold these investments. The earnings grow tax-free as long as the expenses are used for higher education cost. And as we had touched on earlier, I will recommend an attorney to help you draft your estate documents, such as your will, powers of attorney, and medical directives. Regarding your business, I recommend that you discuss with the other owners and put a business succession plan in place. This will prevent potential issues in the event there is a significant change in the ownership structure. I also recommend electing S-Corp status to avoid the double taxation of your business income, as we had discussed a few slides back. In regards to debt management, let's refinance your home mortgage if you're planning to stay at the home for a few years. The initial closing costs will be recuperated and your net savings will be increased annually within a few years. Let's try to pay off the credit card as quickly as possible, as this interest rate of 12% is a big drain on your finances. I have recommended a reasonable plan to pay off the balance within 2 years. Also, in order to increase our emergency fund and get our investments in order, I recommend that we hold off at least 1 more year before purchasing a truck. A possibility to reduce cost even further would be to consider purchasing a used vehicle. Finally, once we have seen your miscellaneous expenses in more detail, I feel that we can find ways to trim expenses in entertainment and miscellaneous categories. Here's an overview of the first year and then annual cost savings for our recommendations. As you can see, our first year will come out to a net additional expense of about $5,000. However, annual savings will be $7,000 annually and growing after the credit card payments are completed. You will have adequate insurance coverage and can begin funding retirement and education accounts appropriately. The future benefits will be able to far outweigh the initial upfront payments. I won't go into too much detail on these projected financial statements, but I do want to note that if we were to implement our recommendations, you can see that your money market and investment assets have begun to rise and your net worth would be increased to about $100,000 next year. Again, you can see the changes are beginning to pull your allocations more in line with the benchmarks. With the changes in over time, we should see the investment assets and net worth increase to levels we would like to see. After implementing our recommendations, we can see that your net discretionary cash flow is about even for the current year, but it also takes into account the increase in the emergency fund by $7,000 and the additional retirement contributions. The following year would see your discretionary cash flow as a positive number, and your cash outflows falling significantly after your credit card payments are finalized. We would then be able to filter that excess cash to a new vehicle or to an increase in retirement and education funding. Our changes to the cash outflows have helped your savings, living expenses, and debt payments shift positively towards the benchmark and more in line with our goals. Here is a slide to emphasize the importance of funding for retirement as soon as possible. As the red line on the chart shows, we are assuming a savings plan of only 5% annually. The funds begin declining in your mid-60s following retirement and only last until your early 70s. As we had discussed earlier, if we were to increase the investment to 10% per year, you would see your line overlap the blue line and last until your mid-80s. This shows the importance of making this shift to 10% as quickly as possible to reach your retirement goals. This graph shows a projected 5% contribution to an education fund. You can see that it is projected to cover college education expenses when your future child turns 18. You can see saving for a college education early is extremely important. Alright, I believe we have covered our agenda for the day. We went over your financial information and my recommendations to help get you both headed in the right direction for the future. Please take your time and review the recommendations and do not hesitate to give me a call if you have any questions. Look forward to setting up a meeting again soon so we can start putting our plan into action. Thanks and have a great rest of the day.